Hello, today is Monday, March 17th. We are looking at the VIX, and as you can see, it is getting crushed the last couple of days, and today is down 1.2 points. Some of you may quote this in percentage terms, say, wow, down 6%. Vol is getting crushed, and we are here to say, no, not the case. Now, what's interesting about this is VIX expiration is tomorrow. It's an unusual Tuesday expiration, which means that March VIX expiration options, the last day that they could trade was today. That's Monday. And these things all expire at settlement tomorrow, which is the 9:30 a.m. cash open. So wherever the VIX index is at that point is the value used to figure out the settlement for all these VIX options. So today, the last day you could trade VIX options. We don't think that's a coincidence that the S&P rallied so strongly today as a result. You can in fact see that if we move to the S&P chart, where you can see again, nice 64 basis point rally today. Now you may notice something, VIX expirations right here. The last VIX expiration in February marked the all-time high in the S&P, or very near the all-time high S&P. And since then, it has just been basically down. And so now what happened? We had the VIX tagging 30 last week, and now into VIX expiration, VIX is contracting sharply and the S&P is catching a nice bounce. Well, why is that? Well, let's look at VIX positioning for the dealers. If this is a negative gamma strike on your screen, it means dealers are short that position. And so what you can see here is that dealers have a lot of shorts above 20, and then at 20, the dealer short position goes away. And so if you were to follow kind of a Max Payne theory with 260,000 calls set to expire tomorrow at the VIX 20 strike, one could imagine that getting the VIX down into that area could create a lot of pain for those against the dealers, as the most calls would expire worthless. So there is some incentive you could think or position here to say, hey, let's get the VIX pushed lower. Now, one of the ways that you get the VIX pushed lower is you could sell S&P 500 puts, and that will send the VIX lower, and that could lift the market up. People would call this a Vanna rally. So is that what we are getting today? Because obviously the VIX getting crushed, that tells us, hey, Vanna must be a driver. But let's look at fixed strike vol for a clue that tells us that vol is actually not getting sold. So what does fixed strike vol show us? Across the x-axis here is all of the strikes in the S&P 500, and across the y-axis here is all the expirations. So what this matrix is specifically set to is the change in fixed strike vol from 3/14, so that's Friday night's close, to right now, which is Monday afternoon. If the market rallied 60 basis points and the VIX went down 1.3 points, wouldn't you think that that was a signal that volatility itself, or implied volatility itself, was going down? You would, but that's not what happened. If we hover over this matrix, we can see for all values around where the market closed, which is right here, we're actually modestly higher in many cases. As you can see here, we're up 30 bips for the end of March. And if we go way out to the end of April into May, we could see, okay, there's roughly a 1/3 of a vol point change across the fixed strike spectrum, so to speak. And that's really about it. There's some evidence that maybe some higher strike calls were getting sold into this. As you can see here, there's a little bit of a darker relative red. But overall, this is a very quiet surface relative to the fact that the VIX seemed to drop down so much. So why does this matter for all of us? Well, in our founder's note this morning, we were flagging VIX expiration as a critical time frame. And what we were specifically saying into this is that, look, VIX expiration has the potential to clear out a lot of the downside pressure and allow a little bit of a relief rally. And you can see that in these notes here. You can see it at the top of our matrix that we highlight these critical dates. And we even say that here, like, look, with the major VIX expiration today, there is this resistance zone here. But what we really want to do is set up to short into this rally. And it was before the market had opened today, before we saw the change in fixed strike vol, we know that today could very well be a unusual rally for the market due to VIX expiration. And then when we go in now and we look at fixed strike vol and find out nobody actually sold vol, what that is telling us is that traders are not saying, hey, there's now less risk out in the future. In fact, if you look at the volatility term structure here, what you see is that we have FOMC coming up, and then we have the Trump tariff news, and those are events that have a lot of what we call event volatility assigned with them, which is essentially saying the market is worried about that risk. So even though the VIX dropped today, fixed strike vol not budging says nothing has really changed. Today was a positional rally based off a bunch of VIX expiration positions expiring, and then we suspect that that means that the market could easily mean revert from this high of around 56.75, in which case we would likely see VIX and the volatility start to mean revert and shift back up to 25 into the end of the month. So we hope that this analysis was helpful. We hope that you understand why fixed strike vol can be so valuable. And if you have any questions on this, head over to SpotGamma.com and sign up for the Alpha subscription. If you do that, you can get access to the fixed strike vol montage, our trace tools, and SpotGamma analysis.